Hello students, welcome to StudyIQ. We will continue our discussion on economy. We are in the module banking. Okay, so actually we have talked about NPAs, different classification of NPAs. So in this session we are actually going to talk about the various schemes to reduce NPAs. Okay, now I've already discussed with you the problem with respect to NPAs and various classification of NPA. For example, what do you mean by NPA? Default of more than 91 days. Okay, 91 days or more default on a loan with respect to the payment of principal or interest. If there is a default for 91 days or more, that is considered as NPA. So more than 91 days default. Okay, so that is what considered as NPA. Now what are the different types of NPAs? We have discussed substandard assets, first one. So substandard assets. So we have discussed about substandard assets. In that I have told you, if a bank loan remain as NPA for less than 1 year, that means it is crossed 90 days, it is default for more than 90 days. So more than 91 days and less than 1 year. This is what substandard assets. Now what is the second category? We have discussed about doubtful assets. Okay, so doubtful assets. So this is actually NPA for more than 1 year. Okay, so more than 1 year, that is what doubtful asset. NPA, that means obviously more than 91 days, or you can say 1 year, more than 1 year the principal or installment is actually due, in this case doubtful asset. What is the third category? We have discussed about loss assets. Loss asset. Okay, so this is actually remain NPA for more than 12 months, and that means this condition has to be there, NPA for more than 1 year, and it has been identified by the auditors as it is non-recoverable. So it is more than 1 year NPA and it has been identified as non-recoverable, and at the same time it has not been written off from the balance sheet of the bank. Okay, so not written off. So I've told you what is this, how to clear the balance sheet. We have told you two cases. One, you can write off. Second is you can give it to the ARC with a small discount. Okay, so that is the way in which you can write off. But when you write off, what will happen? The capital will come down, so it will affect the lending, so the capital infusion is required. So writing off, banks won't go for. Banks rather go with the ARC. And in fact we have also talked about bad bank concept when we discussed about this. So all those things we have done, and if you have missed out any of my previous video, you can get in touch with me here. This is my Instagram, Zia Safir, and please join the Telegram channel. You will get everything which is required for civil service exam. Complete history is there, economy is there, post independence is there, ethics is there. Okay, so you will get almost all the videos content which is required for civil service exam in the Telegram channel. And if you are watching this video for the first time in this channel, please consider subscribing the channel StudyIQ also. Okay, so let's continue with the discussion. So loss asset means it has been identified the authorities as non-recoverable but not written off. So then what will be this bad debt? Bad debt, it is actually written off from the balance sheet. Okay, so written off from the balance sheet. So these are the classifications of NPA. Now even before a loan becoming NPA, before that again there are different classification, like default of 1 month, default of 2 month, default of 3 month, right? More than 3 months is what your NPA. So you can identify certain loans which is showing certain kind of weakness, 1 month, 2 month, 3 month. If you can identify that weakness, you can actually prevent that loans becoming NPA. Okay, so what was that? Different cases, special mention account. So we have discussed about special mention account. So SMA, and what are the different type of special mention account? Special mention account means default for less than 90 days. Okay, so less than 90 days or up to 90 days, less than or equal to 90 days. 91 and more, it is NPA. So here you have three classification. SMA 0, that means default up to 30 days. Then SMA 1, that is default up to 31 to 60 days. Okay, 31 to 60 days. SMA 2, it is actually 61 to 90 days. 90 above NPA, and then within NPA these are the different classification. Within special mention account these are the three classification. So we have also talked about restructured loan, that the bank will restructure the loan if the loan is showing some signs of weakness, okay, and the restructuring will be done in terms of interest payments, in terms of principal payment, in terms of extension of loan. In different cases restructuring could be done. So we have discussed about all those things. So in this session we are going to specifically talk about various schemes to reduce NPAs. So scheme to reduce NPAs, okay, schemes to reduce NPAs. So the first one, Joint Lenders Forum, JLF. So first one, Joint Lenders Forum, JLF, okay. So RBI actually issued this JLF guidelines in 2014. So RBI issued JLF guidelines in 2014, okay. Now here I will write what is JLF, and then we can discuss also. See, under this, okay, in case of a default, so in case of a default on loans of rupees 100 crore, so if there is a default of loans which is above 100 crore or more for a period of 60 days, okay. So understand here, it is not yet reached NPA, it is now going to become SMA 2, okay. So period of 60 days, that means special mention account 2, okay. So I would write here SMA 2, period of 60 days. So in this case, banks or the financial institution, the lenders, okay, so the banks can establish a joint lenders forum. So this is what, if the loans above 100 crore and more, if it comes under SMA 2, not yet NPA, 60 days there is a default, so JLF can be established. So now within 45 days of its establishment, the JLF will prepare a corrective action plan. So within 45 days JLF will come up with a corrective action plan, which may include hand holding or restructuring or even recovery, okay. So corrective action plan, CAP, which may include hand holding, okay. Hand holding means holding the hand. You may give additional loans and will help, okay, so that the company may be able to recover the crisis. So that's what you mean by hand holding. So it may include hand holding, restructuring of loan. Restructuring means you might, so this is 100 crore, okay. So for let's say 2 years you paid continuously, so you might have paid 20% of this, around 20 crore is paid. Now maybe 80 crore is pending, let's say let's say 2 year. So 40, let's say this is for 10 years, okay, this is for 10 years. So 2 year you paid, 20% is paid, rest 80 crore is pending. So what you can do is, you can 2 year is already paid, no, so still you can make it as 10 year, so you can extend the tenure. So what will happen, automatically the monthly payment will come down, okay, which may be payable for the company. So that's what you mean by restructuring. So it could be done either through restructuring or even recovery, okay. So even recovery, so it could be the CAP, corrective action plan, can include hand holding, restructuring, recovery. So I hope you understood what you mean by hand holding, what is restructuring, recovery, anyway you know, okay. Now one more condition, the CAP should be ratified. CAP should be ratified by at least 75% of the creditors by value, 75% of the creditors by value, and 60% of creditors by number, okay. So by value 75% and 60% in terms of number. Now, actually it replaced the debt restructuring guidelines, okay, corporate debt restructuring guidelines, which was issued in 2013. So the agreement between bank and debtor here, okay, so the corporate debt restructuring agreement is actually the agreement between the bank and debtor. So actually what I'm saying is JLF is replaced this corporate debt restructuring guidelines, which was issued in 2013. So now JLF, Joint Lenders Forum. So I hope you understood about JLF. Next is about strategic debt restructuring. Very important, strategic debt restructuring. Okay, so SDR. So let me write it down first and then I'll explain. SDR guidelines in 2015. Okay, so JLF in 2014, SDR in 2015. One more is there, S4A, that is in 2016, and in 2017 prelims you can see S4A question. So in case of default, on a restructured loan, the JLF can convert its debt into equity of the company and can take over management of the company. Okay, so what I'm saying is, in case of default on a restructured loan, so first of all JLF established and restructuring was done. So restructured loan, in case if there is a default after the restructuring, the JLF can convert its debt into equity. That means whatever loan you have given, let's say 10 crore you have given, this could be converted to equity. That means the bank will get the share, that much share bank will get in the company, and the company may be taken over by the management of the company may be taken over. Okay, now if the management need to be taken over, the JLF must be holding at least 51% of the equity, normal. So 51% equity means there should be 51% or more debt should be there, because that debt should be converted to equity, right? So if the management need to be taken over, 51% debt should be there, so 51% of equity, normal logic only. Now next is scheme for sustainable restructuring of stressed asset, S4A. It was actually asked in 2017 prelims. Okay, so scheme for sustainable structuring of stressed assets, S4A. Okay, so it was actually introduced in 2016. So JLF 2014, then you can see here this one, strategic debt restructuring, SDR in 2015, S4A in 2016. Okay, so here it is a modification in SDR. You can see here, not complete debt will not be converted to equity. In case of SDR, whatever debt is there, it would be converted to equity. But here, if let's suppose 10 crore debt is there, okay, now if the company can pay 40 crore out of this, then that will not be, or let's say company can pay 60 crore out of this, that means company can pay 60%. So 60% will not be converted to equity. Only the rest of the 40% that the company cannot pay will be converted to equity. Okay, so in this context, the management will not be taken over because it is less than 50%. Okay, so in 2016, so it will actually reduce the burden of the company, right? So I'm saying, let's suppose company is having 60% capacity to pay. 60% capacity to pay, or the 60% of the loan the company is ready to pay. 40% will be, in this context, 40% will be converted to equity. 40% of debt will be converted to equity. Okay, so this, and then what the bank can do, bank can sell it later. This equity can be sold to some other person, third party, to recover the money. Okay, so here the part of equity in this context, earlier it was full equity. Okay, complete loan will be converted to equity. Now under the scheme, let me write it down. Under the scheme, banks can bifurcate their loans into sustainable and non-sustainable components. Okay, sustainable component of the loan consists of sustainable component of the loan consists of that part of the loan which can be serviced. Service means paid back. I've told you 60% is the company is ready to pay back. Okay, so that is what the sustainable component. Okay, so it can be paid back by the company as per its current revenue. That means its payment capacity as per its current revenue. Okay, so but the condition is it should consist of at least 50%. It should be at least 50% of total loan. So if the company is capable of paying 50% of the total loan, which one is applicable? S4A. If the company is not able to pay 50%, then what is applicable? SDR will be applicable. Entire debt will be converted to the equity. Okay, so in this case restructuring is actually happening in terms of, you can see here, sustainable component of the loan will be paid back by the company and the other part will be converted to equity. But here the condition is 50% payment capacity should be there. So the management should be able to pay at least 50% to go for S4A. If not 50%, SDR, the entire debt will be converted. Okay, so 50% minimum requirement is there. So sustainable part will be paid back, non-sustainable will be converted to equity. So non-sustainable part will be converted to equity. Next is very important, SURFACE Act. Okay, so SURFACE Act 2002. So what is this? Securitization and reconstruction of financial assets and enforcement of security interest act. So SURFACE Act. Okay, so here no need of permission from court for the recovery as per this act. So it enables banks to recover their dues through sale of collateral assets without intervention or permission from the court. So banks can recover through sale of the collateral without the permission from the court. Okay, so banks can go for recovery without the intervention of the court. So SURFACE Act. Okay, now there was an amendment that the DM will facilitate the process of auction of collateral securities. Okay, so DM will facilitate auction of collateral, and also DM will facilitate the management takeover of the company. So DM will facilitate takeover of management. This takeover of management under which one? Not S4A, SDR. Why not S4A? Because S4A is applicable only in case if you are capable of paying 50%. So once you are paying 50%, then 50% more, 51% as soon as you pay, you will be retaining the management. Under SDR only there is a possibility of taking over management, and that too if the debt is more than 51%. You got it now? So here taking over the management means I'm not talking about S4A, I'm talking about SDR. The reason is S4A is applicable only in the case where the management is able to pay more than 50% of the debt. Okay, in that context there is no taking over of the management. But here SDR, if the debt is more than 51%, the 100% of the debt will be converted to equity. So equity will be more than 51% of the company, so you can take over the management. In that case, it is the DM who is going to facilitate this. So that's the amendment. Okay, so there is a provision of establishing a central registry. Okay, so there is a provision of establishing a central registry to maintain the records of collateral securities, to maintain the records of collateral securities. Okay, now one more term that you need to know is willful defaulters. Okay, so who are the willful defaulters? So these are companies or individuals who default on bank loans under certain condition, like they have the payment capacity but they are not paying, or they might have diverted their loans, or they might have sold the collateral without informing the bank. So all these are comes under the willful defaulters. Okay, so these are companies or individuals who default on bank loans. Okay, so despite having repayment capacity is there, so despite having repayment capacity they are not paying the loan. Secondly, divert the fund. Okay, so divert the fund to other activities, Third one, you will sell the collateral asset without informing the bank, sell the collateral. So these are companies or individuals who default on bank loans and they have the payment capacity but they are not repaying the bank loan, then divert the funds, sell the collateral. All these are coming under this. Okay, now there was a committee, SS Kohli committee on willful defaulters. So it suggested that there should be certain restrictions should be imposed by SEBI and RBI. So SEBI and RBI should impose certain restriction, so that it's like RBI, what the restriction can be imposed, there should not be any borrowing for next 5 years. So that is one restriction which could be imposed by RBI. And then in case of SEBI, there is no new company floating. Okay, in case of willful defaulting, there is no new company floating, no takeover, no management or director, etc. So those kind of restriction could be imposed. Now what about this term, non-cooperative borrower? Non-cooperative borrower. So these are defaulters on bank loans. These are defaulters on bank loans who do not provide information about their assets and create hurdles in the recovery process. Okay, so they won't provide the information and they create hurdles in the recovery process. So non-cooperative borrowers. So I hope you understood the session. Very small, simple session. We talked about NPAs and various schemes. Insolvency and bankruptcy code I'll discuss later. Bad bank concept also I'll discuss later. So if you have any doubt, you can get in touch with me here. This is my Instagram ID, Zia Safir. My name is Safir. You can join the Telegram channel. You will get all my videos over there. If you want to write an answer writing session, if you want to have an answer writing session or sociology classes or any other program, mains answer writing program, you can mains test series, you can get in touch with me. This is my number 9790 892 697. Okay, so see you guys. Thank you.